are dry. Don't judge me. Hi. Welcome to my bubble, where we do a little bit of adulting, a little bit of healing, and a little bit of creating. We are back. Back hugging. We are doing the final episode of the financial literacy series. Well, by that I mean we are at the end of all the videos I have planned. If you have any other finance related questions or want any other finance designated videos, leave them in the comments of this video or the other financial literacy videos. Go watch those too. If you don't feel like going back, I made a playlist. Go watch the playlist. Yeah, so today we're getting into building a portfolio. What is a portfolio, you may ask? A portfolio is a collection of assets. Spread fingers. Just think of a portfolio as having all your assets under one roof. You know? If you don't want to keep track of your own portfolio, you can outsource to like a robo-advisor, or you can get a financial advisor to keep track of your portfolio for you. But if you can't afford that, the key to building your own portfolio is, or the key to your portfolio in general is your risk tolerance, which is basically your willingness to remain calm in the down times. You just got to take your L. You got to take the present L in the hopes for future gain. To what degree you want to take that L is up to you. It depends. That's your risk tolerance. How much you are willing to lose in order to get a higher return later. So your portfolio is not only related to the amount of time before your financial goal, like retirement, but it's also how you mentally respond to the fact that the market is going up and down. That's what you need to think about when you're creating your portfolio. Not just, unless you have portfolios for different things. If you want a short-term, you can have short-term investments and have a short-term portfolio. And short-term being like now to your retirement or whenever you want to see the money back. Most people who have a portfolio tend to do long-term. Well, longer than that. So you got to be able to ride out the lows and the highs for the end game. Set your own end game date. It all just depends on what you want to do and what your intentions are going into it. If you are making a portfolio for long-term goals, you'll have more time to ride out the peaks and the troughs of each individual stock in the market, or just the market in general. But if you're looking at it short term and you're looking for something like retirement or even shorter than that, you might not be willing to have such high highs and such low lows. It all depends on what you want to do. So once you decide what kind of portfolio you want to have, there are 4 steps to building a portfolio and a 5th step to maintain it. Step number 1. Are you building the portfolio yourself, or are you having a robo-advisor? Or paying for a financial advisor? Robo-advisors automatically consider your risk tolerance for you. And if your overall goal is to build and manage your portfolio, it's for you. It's good for you? Question mark. Step number 2 / question number 2. Do you need a separate account? Can you afford to have a separate account right now? Are you making investments out of pocket? Or do you have a designated account to your investments, for your investments? How do you want to go about it? You can make an account just for your investments. You can make an IRA account, which are normally meant for retirement. Or in general, you can just have a separate account that you track all your investment stuff through. And most of the time there's a tax advantage to that for the money that you invest. Basically, you could get a taxable brokerage account, which is basically like a down payment on a house, but for non-retirement goals. You know? Does that make sense? For if you're looking at more short term, like you're trying to have money in the next 5 years, you may be more interested in having an account like a high yield savings account. So after you decide, are you paying out of pocket? Do you have a separate account for it? What kind of account are you going to get? IRA, if you want to do retirement, or you can just, have a separate account and that be brokerage and you get your tax advantages, or just have a high yield savings. What kind of account do you want to do? Step number 3, choose your investments and your assets in that portfolio. Now, is your portfolio going to be only stocks, but a variety of different risks? Are you going to have stocks and bonds? Are you going to do a mutual fund? Do you want a mutual fund or something like a mutual fund? What are these different things? If you haven't seen these videos, you can go watch this too. If your portfolio is only stocks, that means those are all these shares you own to companies. The risk associated with that is that the stock you're just hoping that the stock is going up. Maybe it doesn't go up, maybe it goes down. To mitigate the riskiness of a solely stock-based portfolio, you could get something like a mutual fund or an index fund, which they hold a collection of stocks from a wide variety of companies. Now, normally those are, like if a company offers you a mutual fund, it's attached to, like somebody's keeping track of it for you, like it's done for you. But you don't get to pick your stocks. It's your diversity is established for you, if that makes sense. Not to say it like that, but that's what's happening. If you have bonds in your portfolio, it's basically a bond is like you loaning money to a company or the government, and eventually that money will get paid back to you over time, after a certain time period. These are less risky, but they tend to see less return. Like you're going to have a fixed interest amount on that money. So you might get that money plus like 12% if you're lucky. Well, never mind. But so it's certain money, but it's not, there's no necessary promise that you're going to get more back. Then you have the option of mutual funds. Here with mutual funds, you have more diversity. They're less risky than individual stocks. If you haven't seen the other videos on how to tell if a stock is good, if it's bad, if it's how to track how a stock moves, go watch that video. It's in the financial literacy series. But yeah, some mutual funds are actively managed, but those will then come at a higher fee because you're basically paying for a financial advisor. If you're not managing yourself, you're paying for somebody else to do it. And mutual funds don't tend to deliver high returns either, or at least not higher than the passively managed funds. If only difference between active and passively managed is passively managed, say somebody will check every quarter, versus actively managed is somebody's checking every month, every couple weeks. That's the only difference. So choose your investments, choose your assets, however you're going to choose them. That was step 3. Step 4, you're going to decide an allocation strategy. Once you decide which assets are going to be in your portfolio and what things you're going to designate your money to, you decide how you're going to split the money. Borderline like a budget, but in relation to your stocks. You're going to split them between the different types of assets. most times slash the common practice is to subtract your age from 100 or subtract your age from 110, and then whatever that number is, that's the percentage that you put towards your stocks. Now, when you're creating your portfolio from scratch, it may help to look at model portfolios. There are a couple different types. You can have an aggressive portfolio, something like 85% stock, 15% bonds, so mostly risky. You can have a moderate portfolio, which would be like 60 stocks, 40 bonds, so like not quite half and half, but like a little bit more, enough bonds to balance out your stocks. Or you could be conservative and do like 30% stocks, 70% bonds. That's the like, I know I'm getting this money back. This money, I can do without it. Okay, that's step 4. Designate or decide an allocation strategy, how you're going to go about it. Those are the 4 steps of building a portfolio. Step 5. Now, every so often, if you are managing by yourself, every so often you have to reevaluate your portfolio. You have to look back at how your stocks have actually done. How have they made you money? Have they lost you money? Are you willing to deal with the amount that they have lost and or earned in the name of earning more if you wait longer? Every so often you got to check in. See how your stocks have changed in relation to how you thought they were going to change. Rebalance your portfolio, like so it's back to so the percentages are back to your original intentions. You won't have to do any of these steps if you have a robo-advisor, because it will automatically be done for you. You have to pay for it though. And basically, you can decide however frequently you want to reevaluate your portfolio. If you want to do it at specific time intervals, or you want to do it each time an asset goes outside of your percentages, that's up to you. You want something done right, you got to do it yourself. But yeah, that is how you build and maintain your stock portfolio. If this is your first time or your first video within the financial literacy series, you have no idea what I'm talking about. Go watch the rest of the financial literacy series and it'll make sense. I am spreading my financial literacy with the world. So if you don't know how to budget, or you want to get into buying stocks and things, or you're just interested in investments, period, watch the rest of the financial literacy series, because this is the end. We've come to the end. But if you want to see any other financial related videos, leave it in the comments and we can talk about it. We can learn some things together. If you made it to the end of the video and you don't know me, hi. My name's Naori. Stick around. You love it here. Duh. Embrace being a star. Subscribe. You hear my bones cracking? Don't judge me. We are authentic and non-judgmental on this channel. Okay? Follow all my socials. You see that? We're on the go, okay? When you see this, I will have just got back. So my next couple videos will be trip related. But yeah, I'll see you in my next video. Bye.